Well, score one for the economists. The forecast was for 220,000. We get 220,000 for the week ending December 2nd. A little bit up from what we saw the week before. It's an increase of 1,000 from the revised level of 219,000. So almost no change there. It is a little hard to seasonally adjust during the holiday periods, but we have what we have. We did get a downward revision to continuing claims for the week prior to 1,925,000, and last week it was 1,861,000. So all those stories, the narrative that jobless claims were starting to send a signal that the economy was slowing down and the labor market was getting loose, not supported by this data.
McKee not cooperating, folks. Markets churn here, I would put it, with a 10-year yield 4.16%. I went right to the 4-week moving average. It's, nudgy 1 week, 2 weeks, 3 weeks, flat at 220,000. What are the ramifications of a flat, unchanging statistical labor market?
Well, it would suggest over a longer period that unemployment is not going to be rising significantly. And of course, unemployment is what the Fed is using as their basic labor market barometer in terms of policy. So it would be good news in that sense. There's a question about what we get tomorrow. 3.9% is unchanged forecast for November, but there are some analysts like Bloomberg Economics who think we'll go to 4, which then possibly triggers the SOM rule, and you'll get people wringing their hands about inflation. So we'll see tomorrow, but right now, the overall grouping of numbers doesn't suggest any concern for the Fed on the labor market side.
No, quite the opposite. This is just Goldilocks again and again and again. This one, not only did you get bang in line with expectations, you also saw continuing claims go down. You see the response in equities, a little bit of a lift. Yeah, you see bond yields marginally higher. This raises this question of, are we getting the immaculate disinflation that so many people had been expecting? Is there anything in this report that suggests otherwise?
Not in this report. I mean, the idea that the immaculate disinflation is happening just keeps getting more and more evidence in its favor. But until it's over, we're not going to be, nobody is going to take that victory lap. I saw some commentary this morning that said the Fed shouldn't be taking a victory lap. Well, they're not. They're actually kind of leaning the other way because they don't want to be caught out again as they were when they were slow to respond to what was not transitory inflation.
Get out front quickly of the jobs report tomorrow at 8:30. There's the headline data. There's also the Mike McKee data beneath it. What will you look for beneath the headline data?
Well, we'll look both at unemployment but also at average hourly earnings. They're expected to rise on a month-over-month basis, which can be affected by a number of different things. But the year-over-year numbers forecast to fall to 4%. Fed looks at 3 to 3.5% as sustainable under 2% inflation. So it's continued progress in that direction. We'll also see how many people join the labor force. That's been a big reason that unemployment has gone up. If they don't, then we may see a tighter labor market number.